Oh, hi. Welcome back to the continuing lecture of in corporate finance. And today's topic um, is um, it, a full-scale example of actually today's topic is full-scale example of a marginal cost of capital. And just to recap what we did in our last class, we uh, did an example of a marginal cost of capital, and um, in the uh, projected, uh, uh, capital project, and we found where uh, the break in the weighted average cost of capital is happening, right? And then until that break happens, right, the marginal cost of capital is uh, constant at the previous weighted average cost of capital, and then once uh, the break happens, the weighted average cost of capital takes off and resettles at a higher level. So we can also combine the concept of marginal cost of capital with the investment opportunity schedule. So we already know what investment opportunity schedule is. It's basically how the cost of capital and how the internal rate of return and the cost of capital cross each other, right? So the marginal cost of capital and internal investment opportunity schedule plotted together show which projects should be undertaken. So if we take a look at the example, right? See what doesn't this look familiar? Because we did a similar example before. I mean, when we were talking about the NPV and investment opportunity schedule, right? Now, of course, these are potential projects, project A, B, and C, D, and E. Of course, you pick the projects, right, that have higher return, right, than the cost of capital, weighted average cost of capital. So um, projects A, B, and C are all acceptable because their returns, expected returns, are greater than the average weighted average cost of capital, right? And in our previous example, the weighted average cost of capital made a jump, right? A break, right? In other words, there's a change in marginal cost of capital after the $5 million point, right? So when our required capital goes beyond 5 million, then the weighted average cost of capital increases to 10.4. Now, projects A, B, and C are all above. I mean, first of all, A, B are above, way above, right? The initial weighted average cost of capital. C is also above that. And even when our weighted average cost of capital goes up, still A, B, and C satisfy that average cost of capital. but D and E don't, right? And after passing 10 million, I mean, almost passing about, I would say, about 12 million, right? Then again, 12 or 13 million, then marginal cost of capital, I mean, weighted average cost of capital, once again, uh, jumps, right? Because, more expensive capital is being, source of capital is being used. Now, so back to marginal cost of capital, interpretation of marginal cost of capital. The firm's weighted average for the planning period is at the intersection of the marginal cost of capital and um, investment opportunity schedule, which is, basically what this is telling you. So let's move on to the next, the final example. It's a comprehensive example. So this is like a mother of all examples. It's because it's very comprehensive, right? I mean, it's more. What I'm saying is, it's more realistic because in more realistic uh, corporate finance situation, right? A more realistic actual business situation. The decision depends on a lot of, not just a couple of factors. It depends on a lot of multitude of factors, right? So, okay, let's, without further ado, let's dig in. Now, Baxter Metal Works has the following capital elements. Of course, they will have three capital components: debt, preferred stock, and equity. Baxter issued $1,000 30-year bonds 10 years ago at the coupon rate of 9%. 5,000 bonds were sold at par value. And similar bonds are now selling to yield 12%. Here, it's 30-year bond, right? And it was issued 10 years ago. What does that mean? The maturity life left on this bond, right? Time to maturity is 20 years, right? And then the coupon rate was 9%, but it was sold at par. What does that mean? There are only three possibilities for the price of the bond. You're from Finance 100, Principles of Finance. You should remember this. The bonds can sell above par value, or at par value, or below par value. So when the bonds sell above par value, it's called a premium bond. And if it's selling at par value, it's just, selling at par value. I mean, there's no particular name for it. I mean, if I name it, it would be called, par value bond. Or the a third possibility, selling below par value. In this case, that's called discount bond. So, excuse me. So the how does it become a premium bond, or how does it become a discount bond? In Finance 100, right? The reasoning, the logic behind it was, and this was also verified by actual examples. If the coupon rate is greater than the discount rate, right? Now it becomes a premium bond. It sells above par value. And if it's the other, it's the other way around, meaning, discount rate greater than the coupon rate, or coupon rate being less than the discount rate, then it becomes a discount bond, or selling below par value. Then the only other case where the bond sells at par value, I mean, the explanation would be quite obvious. If the discount rate is the same as the coupon rate, then the bond will sell at par value, right? So then what does it tell? What is telling? I mean, this is a telltale sign. If it was 10 years ago when it was sold, it says it was sold at par value. Then we can tell something about what was the discount rate at the time. What was the discount rate at the time? Can you? If it was selling at par value, then the discount rate was, or the prevailing market rate, right? Prevailing market rate was also 9%. It must have been the same as the coupon rate. Okay, get it into your system, right? It's there's no, I mean, from principles of finance, this should have been already running in your bloodstream, right? Logically, it's quite logically, it's watertight, right? There's no this is making a logical sense. Why? First of all, if the prevailing market rate, discount rate is always the prevailing market rate, or the average rate that is being average yield of the bonds of the same risk class, right? Then think about it. If the coupon rate is greater than the average yield of the or average coupon rate of the bonds of the same risk class, then obviously there will be a lot of demand for this bond, don't you think? Right? On average, all the other bonds of the same risk class are paying 5%, but this bond is paying 9%. Wouldn't anybody want to buy this bond? Right? I mean, if you can think logically, this is, there's no way, no other way, there's no way around it. I mean, this is the only way it can go. So that's why the strong demand, right, overwhelming demand for this bond will push up the price. So it sells at par value. And it's exactly the mirror image for the discount bond, right? So this will give us, then what does that mean? Currently, similar bonds are now selling to yield 12%. What did I say? This is one of the ways it is worded, right? They never say discount rate is 12%. That's not the way it is worded. The way it is worded is that the similar bonds are price to yield 12%, or comparable bonds are price to yield 12%, or prevailing market rate is 12%. Well, that's how it is worded. That means this is the discount rate now. Use this as the discount rate. And think about it. If the discount rate is higher, that means the whole fraction goes down, right? I mean, if it is giving you 12% yield, that means it's currently it is a discount bond, because the coupon rate is 9, which is way less than 12%. So, of course, it will be selling below par value now. So then we can calculate the bond price, rational price of the bond, and then multiply that by 5,000, and we can find the market value of the debt, right? Market value of the debt. And the preferred stocks, they sold 20,000 shares of 10% preferred stock 5 years ago at 100%, $100 par value. So that means, dividends. The preferred stock is a perpetuity, and it's paying constant dividend. So 10% of $100 is, $10 a year. The dividend is $10 a year. Then, using the perpetuity formula, right? Excuse me. And this is the discount rate. 10 over 0.13 must be, then we can easily get the current market price. Of course, the market price may be different. Also, in the case of the bond, it's the same. The market price may not be necessarily the same thing as the intrinsic value of the bond or intrinsic value of the stock. But again, in the short run, there will be a lot of there can be more likely to be a discrepancy between. The actual market price would be different. More likely to be different in the short run from the rationally expected price or the intrinsic value. But our assumption is there is no. Our assumption is it's the long run price or based on the perfect information assumption, right? Perfect, foresight or perfect information assumption, meaning, all the market participants have perfect information about the asset. So there won't be any irrational pricing, right? And then, market price would be equal to the intrinsic value, right? Now the equity. The company was originally financed with the sale of 1 million shares of common stock and $10. That means, the par value of the stock was $10 at time zero. At time zero, when the company started out, $10 times 1 million, that would be $10 million, right? $10 million was the book value as well as the market value at time zero. But of course, the market value would evolve, right, over time. And the company is already, look, even if we take 10 years ago as time zero, because 30-year bonds were issued, right? 30 years ago, 5,000 of them. 10 years ago, right? And if we assume that was the time they started out, of course, that's not necessarily, it doesn't have to be, but even if we take that as the starting point, right? The book value at the time, 10 years ago, or book value and market price at, market value at time zero, which was 10 years ago, was like 10 million. But 10 years, if 10 years have passed, now it would be different, right? Now, accumulated retained earnings are currently 3 million. Okay, so currently 3 million is retained earnings, and this is the initial source of capital you can use for any capital projects, right? The stock is now selling at $12.50. So the price has moved from $10 to $12.50. That means, I don't know, it could be 10 years or it could have been 1 year, but the fact that the market price is $12.50 means, at least there has been positive expectations about this company. So the market price is, greater than the book value, right? And the market value of the common stock is then $12.50 times 1 million, then $12.5 million, right? So this is relatively easily, done. Now, next thing is, how do we take a look at the capital structure? Their target capital structure is 20% debt, 10% preferred stock, and 70% equity. Now, other information, Baxter's marginal tax rate is 40%. This would be a very relevant information when we effective, when you calculate the effective, adjusted cost of debt, right? Flotation cost, 10%, right? Also relevant, when we are calculating, effective cost of equity, right? Now, short-term treasury bill, which is, risk-free return, is 7%. Average stock yield, or market return, is 13.5%. Baxter's beta 1.4. This is all needed for CAPM, right? CAPM model. Baxter's beta, yeah, and then earnings growth rate indefinitely. Earnings, assuming a constant growth rate indefinitely, that means what? A golden growth model. Use golden growth model for valuation of the stock, right? 6.5%. Annual dividend at time zero is $1.10 per share, right? And then to use golden growth model, we will need dividend at time t plus 1, or time 1. And with the growth rate, we can do that. And expected earnings after taxes, or net profit, in time 1 year later, right, at the end of the year, expected at time 0, is $2 million, and of which $1.4 million will be retained. Yeah, out of $2 million, $1.4 million will be retained. What does that mean? $0.6 million will be paid out as dividend, right? Otherwise, if nothing is paid out as dividend, then entire $2 million will be retained earnings. So these are other information that is necessary. And also remember, retained earnings is the initial source of capital for future capital projects. So capital component weights and weighted average cost of capital. What is the capital component weights and weighted average cost of capital before and after retained earnings break? In other words, after retained earnings are exhausted, right? Then the weighted average cost, marginal cost of capital will, there will be a break in weighted average cost of capital. So marginal cost of capital increases, right? Sketch the firm's marginal cost of capital schedule, right? Okay, so calculating, first of all, bond price. We know how to calculate bond, right? So following that, the price of the bond comes to intrinsic value of the bond comes to $774.28. Now, so bond, I don't want to go back to the previous lecture, and this is something you should know from Finance 100. But basically, it's the present value, bond value, bond price depends on the present value of annuity, because all the coupon payments are annuities, and then the present value of the face value $1,000. So it comes to 774, and then there were 5,000 bonds issued, so times 5,000, so it comes to 3.871 million, right? Now preferred stock is a perpetuity, and the perpetuity formula is dividend over discount rate, or the cost of capital, cost of preferred stock, right? So $10 dividends, and currently cost of capital is 13%, because it said, it is now price to yield 13%, right? Price to yield 13% means, what should make this $10 dividend 13%? Then the $76.92 price will make this $10 dividend 13% of that. And then there were 20,000 shares of preferred stock, so multiply that by 20,000, then it comes to 1.538 million. Common stocks, we already know, 12.50 times 1 million, so 12.5 million. So if we find the weight, right, although based on the market value, right, if you find the weight, it's going to be debt will be 21.6, preferred stock will be 8.6, equity will be 69.78%. So it's close to our target capital structure, right? It's close, but it's not exactly the same. But we are close, right? So let's calculate the effective cost of capital. And we know cost of debt, which is currently 12%. That's what the market yields, right? That's what the bond yields, right? Similar bonds. But there's a tax shield. In other words, you get tax benefit by as much as you get the benefit by as much as the tax rate. So tax rate, it said Baxter's marginal tax rate was 40%, wasn't it? Go back to other information. Yeah, Baxter's marginal tax rate, 40%. There you go. So 12% times 1 minus tax rate. So that's going to be 7.2% is the adjusted or effective cost of that. And then cost of preferred stock. Actually, I should have made this a subscript, right? But cost of preferred stock is must be adjusted for flotation cost, right? So 13% over 1 minus the flotation cost, 10%. It comes to 14.4. So actually, that's the adjusted preferred stock. And equity, cost of equity by while you are still financing it with retained earnings. We have 3 methods, you remember, right? By using CAPM or Gordon growth model or risk premium method, right? And you might wonder, cost of equity, that makes sense. That's the symbol. Why is it KB? That it means Baxter, right? Company name Baxter. By CAPM, cost of equity for Baxter is, right, a risk-free return plus the market premium, right, times beta of Baxter, right? So if you run those numbers, then it comes to 16.1%. And if we calculate the cost of equity using Gordon model, then it comes to, first of all, this is what? Dividend at time one, right? Because it's a, 1-year forecast, right? Dividend at time t plus 1 over price of the stock, current market price, right? And the growth rate. It comes to 15.9. And then by risk premium and their cost of debt is 12%, right? 12%, and we use middle of the road, right? 3 to 5%. So we take risk premium ranges between 3 to 5%, and take the middle value, comes to 16%, right? So if we take the either average or take the middle value, right? Will come to 16, right? And then cost of equity, right? It's basically, if you finance it with new stock, right? We made an in Gordon growth model, we just made an adjustment to for flotation cost, and then it comes to 16.9. The new equity, so then new equity will definitely increase the weighted average cost of capital, right? There will be a break in the marginal cost of capital. So, so we have this, table of weighted average cost of capital before and after the break, right? Before and after the break in the marginal cost of capital. So first of all, weight, we are using current weight based on the market value, right? And then cost of debt, cost of preferred stock are the same. There's no difference before and after. But the equity will, because this is the equity financing using retained earnings. So there's no flotation cost. And after the retained earnings are used up, then you will need to sell new stocks. And when you sell new stocks, then cost of equity will go up. So if we take the weighted average, then this is 13.97. And weighted average after the break, 14.6. And if we sketch the marginal cost of capital, right? Break in the marginal cost of capital, then 13.9 something is rounded to 14, right? And you can finance up to $2 million with the retained earnings, and after that you'll have to sell new stocks, so it makes a jump. And how do we know if this is the $2 million? This break happens there because retained earnings is used, and the retained earnings is 1.4 million, right? And that 1.4 million is 69% or 70% of the first capital financing, right? So out of So this comes to, if you work out this number, it comes to 2.005 million, right? So that's roughly 2 million, slightly more than 2 million from there, right? So in other words, what that means is, 2 million out of 2 million, right? 1.4 million was retained earnings, right? The remaining, that's 70%, right? And then out of 2 million, about 20% was 20% is like 4 million. 4 million was debt, and then about 10%, right? 2 million was preferred stock, right? You can finance with debt and preferred stock, right? Up to 4 million in debt. I mean, 400,000, up to 400,000 in debt. You can finance it out of 2 million. 400,000, 400K is financed with debt. 100K is financed with preferred stock, and 1.4 million is financed with retained earnings. And after that, it has 60% is financed with selling new common stock, right? That's what it means. That's what this diagram means, right? Now, if we do it in Excel, right? So we switch to Excel. Okay, I have sore throat. I mean, so it's really hard to speak. I hope you can. I hope the audio quality is good. So even if I speak softly, you can still hear me clearly, right? And well. Now let's take a look at this Excel. I did it this way. I mean, the breakdown was, very clear. I mean, even from this slide, you get the idea how you can do that. But let's take a look at the so first of all, a debt, preferred stock, and common stock, right? Par value 1,000, preferred stock, par value $100. Equity currently I mean, par value was $10, right? Or the book value was $10. Quantity, they sold 5,000 of them, right? 5,000 bonds, right? 20,000 of shares of preferred stock and 1 million shares of equity. So then originally by par value, right? Think about it. What would you get? You would get, look, right? Book value would be all like that, right? You just copy that and drag it down. The book value will be, yeah, right? This times this, right? And then this times this. And the total will be, total capital will be, right? Sum of all of them, right? Now, and I guess retained earnings. What was the retained earnings? They said at time 0. It was actually 2 million. I guess this was, I guess, typo. But, that doesn't play any crucial role here, so ignore that. Now, weight. Of course, we can calculate the weight easily. But the actual weight, right? So let's calculate the price of this bond. The price of the bond is, and this is, basically bond valuation formula, right? Because this is what up to this. That's the value, the present value of the coupon. Coupon is annuity. So, and then present value of the $1,000 face value. So you come to, you do that and come to 774, and then simply, this times, the total number of shares, right? Total number of bonds, right? So you come to this. And then again, price of the common preferred stock, right? So B4 times E4 is what? That's the dividend, right? That will give you $10, and you divide by cost of preferred stock, right? So then, which is the discount rate, and then you get this, and then of course, then that times quantity, right? Okay, that comes to market value of that, and then equity, right? Common stock, right? Market value is obvious. Market value is using risk premium method, CAPM-Gordon method, right? Currently, it is selling for. This is already given. This is not something to solve for. It's already given. Market price is $12.50, right? Because we are doing the market valuation, right? Market price is already given. In these two, we were working under the assumption that the market price in the market price under perfect market assumption or perfect insight assumption, right? Market or market equilibrium assumption, right? If the market is in equilibrium, right? The intrinsic value and the market price would be the same. Here, normally we would also extend that assumption, but even without that, because we are valuing it by the market price, so we just took the market price, right? So 1 million times this comes to this, right? Therefore, total of that, sum of that, right? And then So the weight, actual weight, is then look, this divided by this, and you lock the denominator. Why? Because that way you can just drag it down, and then you will get the weights, right? Without having to worry about the denominator changing as you go down the road, right? So we got all these weights, and some of the weight will always be 1. The weights will have to sum to 1, right? Either, you can do it by, or, uh, or you can simply sum, right? Auto sum using, you still get 1, right? The weights will have to be exactly sum to 1. Now, we know the cost of these, in other words, discount rates for these different capital components are like this, right? 12%, 13%, and 4%. I wonder where that 4% was it given? Let's see. Let's go to it seems like this was calculated. Okay. But ignore this number for now because it's let me go back, and where was that? Where did it come from? Where did it pop up from? Oh, okay. So that was the risk premium, actually. This 4% is the risk premium for equity, right? It ranges between 3 to 5%, and taking the middle value, right? But anyway, that's not what determines. I mean, that's just in case of using the risk premium method. That's why this row is risk premium, right? So first, finding the adjusted, right? Adjusted cost of capital pre-break, right? Pre-break, before the break happens, right? Will be, cost of debt plus 4% risk premium, okay? And then using CAPM, right? So F13, which is the market return, right? The treasury bill. I'm sorry, the risk-free treasury bill return, right? F13, and where did I put it? F13 is like there, right? F13, right? 7%, right? Plus G13 minus F13, market return minus, right? Risk-free return, so that's market risk premium times beta, right? Beta, right? So by doing that, we got 16.01 using Gordon model, right? Which is, basically dividend at time zero, right? Dividend at time zero was $1.10. Times 1 plus dividend growth rate. Dividend growth rate was given where? Oh yeah, I put it here. So 1 plus growth rate, right? And then divided by market price of the stock, and the market price of the stock is that, right? And then plus growth rate. That gives you, 15.87. Okay, so pre-break, right? We picked this because it's, middle of the road, right? We picked this as the cost of common stock. And then if we take the weighted average of that, it came to this. Okay, you might wonder, what is that? It's not, does it look like what this is? What I was talking about. This is called the sum product. Sum product is what? You're summing all the products. That means a weighted average is what? Weighted average is this times this, plus this times this, plus this times this, right? That's weighted average. But if you think about it, you are summing the products, right? This times this, that's the product. This times this, that's the product. This times this, that's the product. And you are summing all of them. Hence, it's called the sum product. So that's what it means. I did D3 through D5. That's the row of weight. I mean, you might say, oh, isn't that the column? Yeah, it's column, but in matrix, it's row column operation, column and row, column row operation, column by row, row by column. So this is like the column. This is row, and then in other words, you're multiplying this by this, multiplying, right? This column by this column, right? So that brings you to 13.96%. That's before the break. And then after the break, nothing changes for cost of debt and cost of preferred equity. Nothing changes. But for cost of equity, now it's not going to be like retained earnings anymore. You'll have to make adjustment for flotation cost, right? Because you're going to sell new stocks, right? Of course, the cost of preferred stock was already adjusted for flotation cost, right? It was because, when you sell preferred stock, right, flotation was already included, right? So here, if you then so this is what Gordon growth model, right? Dividend at time zero times 1 plus dividend growth rate over, right? 1 minus growth rate times the price at time zero, right? And of course, I5 is the price at time zero, right? Plus the, this is the flotation, I'm sorry. It's the flotation cost. Plus growth rate, right? I13 is the growth rate, right? So if you do that, you get 16.91. This is the post break, right? Adjusted cost of equity, right? So the weighted average cost of capital after the break, right? After the marginal break in the marginal cost of capital, right? Summing all of those, right? Sum product, right? The weight times this, weight times this, weight times this. There you go. We'll go to 14.6%, right? So where does the jump happen? Marginal cost of capital jump happens, when, right? You remember this is the almost like 60% of the 60% of the initial capital needed, right, before making a jump, right? And so retained earnings is almost 60% of that, right? So D5 is what? D5 is, that was like 70%, I'm sorry. I thought it was about 60%, but that was like 70%. So if you do that, then that gives you the combination of the sum of the capital components, right? Including the retained earnings, which is equity, and the preferred stock, and debt, exactly in this proportion, right? Out of so we already talked about that. So about 400,000, is the debt out of 2 million, right? And about 200,000 is preferred stock out of the 2 million, right? And then 1.4 million is common stock, but that's retained earnings, right? Retained earnings, at time one. Okay. So this is where the MCC jump, marginal cost of capital break, happens. Okay. So that's the example, and I wonder if there is a example 13.2. Do we have that example? Let's see. I think we did this example already. 13.2. So let me go back to the PowerPoint, right? I think the example 13.2 was the one we did before. Yeah, this one. I think this was 13.2, and I did it in Excel, right? Was it 13 points? Yeah, this example, I believe. Oh, this example, right? That was what was there, right? In the in Excel. So that brings us to the conclusion. I mean, rather than conclusion, I mean, it's like caveat against potential mistake. Handling separately funded projects. A project can be funded entirely by a single source of capital. Yes. I mean, it can be entirely single-handedly funded by either equity or preferred stock or debt. But should the cost of capital used to evaluate that project be the cost of the single source, the firm's overall weighted average cost of capital. It should still be the firm's overall weighted average cost of capital, because firms cannot continue to raise a single source of capital indefinitely, such as cheap debt. Yes, think about it. The capital needed for the project is, let's say, uh, $50 million. And of course, the cheapest source of capital is debt. You may borrow, you may finance the project with debt only, but usually, look, um, to that means, to borrow $50 million entirely in debt, you think it's going to be, the interest rate will be uh, still the constant and the same when you borrow? No. Why? Think about it. This is also, principles of finance question. I mean, this is something you should know already. You cannot raise debt capital. You cannot sell bonds indefinitely at the same coupon rate. Why? Think about it. As the debt goes up, total leverage goes up, right? As the leverage goes up, the company's financial distress goes up, which, in other words, default risk goes up. As the default risk goes up, will the lenders still continue to lend at the same interest rate, same coupon rate? No, that is simply, unacceptable, right? From the lender's perspective, as the default risk of the borrower goes up, lenders will demand higher risk premium, right? Makes sense. They will demand higher return. So you cannot keep raising single source of capital indefinitely, right? So that's why you have to use weighted average cost of capital, although a project can be funded entirely by a single source of capital. Okay. All right. So that's it for today. This wraps up everything about cost of capital. So we'll move on to the next topic in the next lecture, and the next week will be about the real options. Okay, this will be an interesting topic. All right. So thank you for watching, and I will see you in the next video. All right. Goodbye.